Welcome. I'm going to show you how disciplined investors generate option income, cycle after cycle. We will cover 3 strategies: covered calls, cash secured puts, and bull put spreads. I'm going to explain each one clearly for beginners with the real risks on full display. This is education, not advice. No promises, no hype. Just the process and the numbers behind it. Let us get into it. Before we begin the part that matters most, this video is general information and education only. It is not personalized financial advice. Options involve substantial risk. You can lose your entire investment. Covered calls and cash secured puts still carry the full downside risk of owning the stock. Past performance does not guarantee future results, and every example you see today is illustrative, not a recommendation and not a guarantee. Before you make any investment decision, speak with a licensed financial advisor who understands your objectives, your situation, and your needs. I am not that person for you. I'm here to teach the mechanics. Quick note for my Australian viewers, because the rules differ. Options trading here is regulated by ASIC, and you will need the appropriate options approval with your broker. Many Australians access US options through interactive brokers, Tasty Trade or Saxo. Be aware that CHESS-sponsored ASX options behave differently and carry lower liquidity than US equity options. On tax, option premiums are generally treated as ordinary income in Australia, not as capital gains. You also carry currency risk on US positions, and brokerage, foreign exchange, and tax costs all reduce your returns. Understand margin and the possibility of a margin call before you trade. None of this is tax advice. Confirm your own position with a professional. Who is this for? 4 kinds of investor. First, long-term investors who want to generate income without selling the shares they already hold. Second, busy professionals who can give this 1 to 2 hours a week and have no interest in watching screens all day. Third, retirees and pre-retirees who want potential cash flow with the risk on every trade clearly understood before they commit. And fourth, disciplined beginners, the ones who value process over excitement, who want a system that repeats month after month. If you saw yourself in any of those, you're in the right place. This channel is built on decades of real-world options trading across bull markets, bear markets, and outright crises. I'm not going to share a lucky year. I'm going to share the process, the one that has been tested through multiple market regimes, decades in the markets, multiple crisis markets navigated, every major regime tested. But hear the goal clearly. This is about a repeatable process, not one outsized year. Your outcomes will vary with execution, conditions, position sizing, and risk management. The edge is the discipline, not a magic number. Let us build the foundation. What is an option? Start with a call. The buyer of a call has the right to buy 100 shares at a set price, the strike. Now flip to the seller's side, because that is where we live. When you sell a call against shares you own, a covered call, you take on the obligation to sell your shares at the strike if you are assigned. Now a put. The buyer of a put has the right to sell 100 shares at the strike. When you sell a put, a cash secured put, you take on the obligation to buy 100 shares at the strike if you are assigned. Two more terms. The strike price is simply the agreed buy or sell price written into the contract. Expiration, or days to expiration, is the clock, and time decay accelerates as you approach it. And the premium is the price the buyer pays and the seller collects. That premium is the income in income investing. One rule to plant right now: the Overlord sweet spot is weekly to about 30-day cycles, and I lean weekly for active management. Here is the core concept, the reason any of this works. Income per cycle. First, cash on day one. When you sell an option, the premium lands in your account immediately before the trade has had any chance to play out. Second, theta is your friend. Theta is time decay. Every day that passes, the option you sold loses a little value, and that works in your favor as the seller. Time is on your side. Third, rinse and repeat. Weekly to about 30-day cycles. Sell, collect, reset, and redeploy that premium into the next cycle. Each completed cycle resets the clock. The premium is yours up front, and the process can be repeated, but remember, the outcome of any single cycle still varies with conditions and execution. Let us turn that concept into a repeatable engine. 4 steps. Step 1. Identify. Liquid S&P 500 stocks or major ETFs. An IV rank between 30 and 50 is ideal, and no earnings inside the cycle. Step 2. Deploy. Sell a covered call, a cash-secured put, or a bull put spread. Choose a weekly to 30-day cycle and collect the premium up front. Step 3. Decay. Theta does the work for you every day while you wait. Step 4. Harvest. Close early once you have captured most of the premium, or let it expire worthless, and then you repeat. Same process, same rules, run again and again over time. That repetition is the engine. 3 strategies, 1 system. The live playbook teaches covered calls first because they are the foundation. Cash secured puts and bull put spreads are the next playbooks in the journey. Quickly, here is when each fits and what each one risks. Covered calls. Use them when you are neutral to slightly bullish. You own 100 shares and you want extra income. The risk is the full downside of the stock, reduced only by the premium you collected. Cash secured puts. Use them when you expect a pullback and you are generally willing to own the stock at the strike. The risk is the strike times 100 minus premium, and you own the stock if assigned. Bull put spreads. Use them when you are neutral to bullish and you want to commit limited capital per position. The risk is defined, the spread width minus the credit. If the stock closes below your long strike, same system, 3 tools. Before any trade, you pick the right underlying. The strategy does not save a bad stock. So run the quality checklists. Is it an S&P 500 constituent or a major ETF? Is daily share volume above 1 million with open interest above 100? Is the bid-ask spread tight under 5 to 10% of the premium? Is there no earnings inside the expiration window? And is the IV rank in that 30 to 50 range? The examples on screen are profiles only, not picks. A broad market ETF for the highest liquidity, a tech-heavy ETF for concentrated growth, a small-cap ETF with higher IV and more risk, a mega-cap tech profile, and a mega-cap bank profile that tends to run lower IV and steadier. Inside the Playbook, the 4-layer screen filters thousands of optionable US stocks down to a small, rules-qualified shortlist each week. That is the work that happens before you ever sell a contract. Let us make it concrete with a worked example, a covered call. Picture a quality blue chip. We will call it XYZ, trading at $200, low implied volatility, 30 days to expiration, and you own 100 shares. Our strike band is the 0.2 to 0.4 delta range. Look at the chain. The 200 strike pays $5, but it sits at the money, delta 0.5, with high assignment risk. The 205 pays $3 at delta 0.38, balanced, more premium. The 210 pays $1.50 at delta 0.27, and the 215 pays 75 cents at delta 0.18, too little premium. We select the 210. Why the 210 strike? Delta 0.27 sits at the conservative end of our band, which implies about a 73% chance the option expires out of the money. It is $10 out of the money, a 5% buffer above the current price, and the break-even is 200 minus the $1.50 premium, so $198.50. That is your downside cushion. Premium collected $150 on day one, about 0.75% on this calm name. Now, the rules aim for 2 to 4% on a 30-day cycle when the implied volatility supports it, and a weekly pays roughly half that. This is a quiet example by design. It is illustrative, not a forecast. 3 outcomes can follow. Outcome A, the stock stays below 210. This is a common intended outcome, about a 73% chance at delta 0.27. The option expires worthless. The buyer's contract is worth nothing at expiry, and you owe nothing. You keep the $150 in premium collected on day one, and you keep your 100 shares, the position unchanged, ready for the next covered call. Premium kept, shares retained, the clock resets. That is the ideal. Outcome B, you are assigned at 210. Assignment is not a disaster, and the math shows why, with one caveat. Premium collected plus 150 on day one. Capital gain, the difference between the 210 sale and your 200 basis, that is plus $1,000, $10 a share across 100 shares. The total plus $1,150. Now the lesson. Opportunity cost is not a loss. You still gained $11.50. A covered call trades some of your upside for immediate defined income. That is the deal you signed up for. The caveat is tax. Assignment realizes capital gain, and in a taxable account that creates tax drag and may trigger capital gains tax. Talk to a tax professional in your jurisdiction before you lean on this. Outcome C, the one covered calls do not protect against. The stock drops 20%. Honesty matters here, so we do not look away. Premium collected plus 150, kept. Loss on 100 shares as the stock falls from 200 to 160, minus $4,000, a paper loss. Net position minus 3,850 because the premium offsets only 3.75% of that decline. 3 truths from this slide. Premium is not a hedge. $150 cushions, it does not protect. And a 20% drawdown swamps a small premium. The downside is full stock risk. The call caps your upside, while your downside is identical to simply holding the stock minus the premium. And the real protection is sizing. Cap each covered call near 25% of capital and only write calls on stocks you would be happy to own anyway. That is where the safety actually lives. Strategy 2, the cash secured put. XYZ at 200. You sell the 190 put 30 days out for $2.50 a share, so $250 in premium, and you reserve $19,000 in cash to back it. 2 paths. Not to signed. XYZ stays above 190. You keep the $250 premium, and the reserved cash frees up for the next cycle. Assigned. XYZ drops below 190, and you buy at an effective 187.50, the strike minus the premium, acquiring 100 shares below where the stock had been trading. But understand the gap risk. If XYZ gaps overnight to 150 on a shock, your obligation to buy at 190 still stands. So a cash secured put is only appropriate on a stock you are generally prepared to own at the strike, even if the price falls sharply below it. If you would not want it at the strike, do not sell the put. Strategy 3, the bull put spread, our defined risk play. XYZ at 200. You sell the 190 put and buy the 180 put at $10 wide spread for a net credit of $1.50 a share, so $150. Max loss $850 per contract. Max profit $150, which is 17.6% on the capital at risk. Capital required $850 against $19,000 for the cash secured put. Now read this twice. The gap risk. If XYZ gaps below your long strike, the 180, overnight on bad news, the max loss is realized instantly at the open. No time to adjust, no time to close. You are risking $850 to make $150. So a single loss can offset roughly 5 winning trades. Size every spread for the gap down case, never more than 2 to 5% of capital on a single spread. How might you put the 3 together? This is an illustrative allocation, an example only, not a guarantee and not a recommendation. On a $50,000 account, covered calls, when you're neutral to slightly bullish, 40%, $20,000. Cash secure puts when you expect a pullback and are willing to own, 35%, $17,500. Bull put spreads, neutral to bullish with defined risk, 15%, $7,500. And a cash buffer for closing and modifying positions, 10% or $5,000. One important nuance, not all of that capital is the same. The cash secured put cash is fully reserved and sitting there. The bull put spread figure is a broker buying power requirement using margin. And where there is margin calls are possible. Know the difference before you allocate. Before you get excited, the important realities. Commissions and slippage reduce your actual yield, and they bite hardest on smaller accounts. Taxes. Premiums are typically taxed as income, and assignment can trigger capital gains tax. Losing trades happen. Even with defined risk strategies, you will have losing months, and one loss can erase several wins. There is a psychological challenge too. Managing positions through a crash tests your discipline far more than your knowledge. This takes time and effort, scanning, monitoring, adjusting. It is not set and forget, and it has real capital requirements, enough to size properly and to hold cash in reserve. The takeaway across all of it, discipline and risk management matter far more than chasing high yields. That brings us to risk management, the heart of this channel. Discipline beats prediction, and anyone who tells you otherwise is not being honest with you. Picture the classic blow-up, an oversized short put position held into a sudden market shock. The pattern repeats every cycle. Too large a position, no event check, and a loss held well past the point it should have been closed. 3 avoidable errors that turn a normal drawdown into a real one. So here are 5 rules that protect you. 1. Size by strategy. Covered calls and cash secured puts up to 25% per name. Spreads 2 to 5%. 2. Avoid earnings. Do not hold short premium through an earnings report unless that is your deliberate plan. 3. Use liquid underlyings. Tight bid-ask spreads only. 4. Take profit early. Close once you have captured most of the premium and do not get greedy. 5. Keep cash reserves. Never deploy 100% of your capital. Follow those 5 and most of the damage takes care of itself. Let us learn the common mistakes cheaply on this slide instead of expensively in your account. 1. Trading too frequently. Chasing premium with too many trades until exhaustion leads to errors. 2. Chasing high premium, because the highest yields usually carry the biggest event or gap risk. 3. Oversizing positions, where too much in one name turns a normal drawdown into a real loss. 4. Ignoring earnings dates, an entirely avoidable lesson, so always check the earnings calendar first. 5. Holding losers too long, because waiting almost always costs more than honouring your rule. And 6. Skipping paper trading, because going live too fast is an expensive shortcut. The first 3 blow up accounts, the rest are paper cuts. Both still hurt, so respect all 6. If you want the full system, this is it. The Overlord's Covered Call Playbook. Practical income in 90 days, built around the Covered Call foundation, in 3 stages and 9 steps. Stage 1, foundation, days 1 to 30. Know your numbers, options decoded, and meet the covered call. Stage 2, strategy, days 30 to 60. Set up your broker account, trading rules, and pick your stocks. Stage 3, execution, days 60 to 90. Place the trade, manage the trade, and review and repeat. The link is in the description, and the code YT100 saves you $100. It includes the 2 gates, the 6 gates, and the 4-layer screen frameworks, and a minimum of 10 paper trades before you ever risk live capital. If you are starting from zero, here is a sane first 4 months. Weeks 1 and 2, set up and paper trade. Open a brokerage account, get your options approval, and put no real money to work yet. Weeks 3 and 4, practice covered calls. Paper trade at least 10 of them and track every single outcome. Month 2, your first real trade, one covered call on a blue chip or a major ETF only. Month 3, add cash secured puts on a stock you genuinely want to own, one contract maximum. And month 4 onward, systemize. Refine your rules, track your results, and repeat the process. Slow is smooth, and smooth is how this compounds. 3 actions you can take right now. 1. Subscribe and ring the bell. This channel runs weekly US market updates, options strategy walkthroughs, and stock deep dives, so that there is something useful every week. 2. Comment. Drop the word covered below to signal you are in, and grab the free Covered Call Qualifier from the link in the description. It runs 5 checks on a stock you already own. 3. Enroll. Join the Overlord's Covered Call Playbook, the live course. Link is in the description. And use code YT100 for $100 off, with lifetime updates included. And if this added value, share it with one friend who invests. That is the best support you can give this channel. That is the system. 3 strategies, 1 disciplined process with the risks shown to you in full, not hidden. This channel is here to decode what separates successful options traders, weekly market updates, option strategy education, and stock deep dives. Remember the 3 words we trade by: educate, discipline, execute. Everything today was for education only. It is not financial advice. And options carry substantial risk that is not suitable for everyone. Past performance is not a guide to the future. Always consult a licensed financial advisor, because this did not consider your objectives, your situation, or your needs. I will see you in the next one.